Good morning. It is the last day of June, and there's a little bit of shakiness in the markets today, although nothing tremendous. And we are at some important levels in the stock market here. The market is trying to make a decision. Does it get another leg in up, or do we start rolling over? And I have an opinion about that, but most people should just wait to see what the market decides rather than speculating. Speculative positions should be small, hedges should be small, and normally we just want to see which way things are going to go. And for the last several weeks, the market has been in a sideways choppy motion coming down off of its highs about 3 weeks ago. And we will take a look at some charts today. And two things that I'm doing that I outlined in a Swinging for the Fences piece yesterday, and why I think that they're actually both pretty easy bets from the right price. So the question is, what is that price? So I updated the technical trading article that I had done about a year ago, and I made this one a little more comprehensive, more explanations, and we'll have a secondary and some other pieces, tertiary, fourth, fifth. There'll be other pieces coming up. The first piece, just technical trading basics, using overbought and oversold signals to buy and sell. These are things that every investor, even if you're primarily fundamental, should use. The richest investors in the world use indicators to know when downward momentum is exhausting or about to pivot and turn around. One of the greatest traders out there, Paul Tudor Jones, who did some amazing things in the 80s and 90s, said, look, I believe the very best money is made in the market turns. Everyone says that you get killed trying to pick tops and bottoms, and you make all your money playing the trend in the middle. For 12 years, I've been missing the meat in the middle, but I've made a lot of money at the tops and bottoms. Now, ultimately, I'd like to make money at both places, the turns and the middle. So the middle of the market, you're trying to pick up a trend. But the edges, those points where buying exhausts or selling exhausts and the market is about to pivot in another direction, are remarkably profitable if you can get a few of those right per year. And it really doesn't take a lot. You don't have to make trade after trade after trade after trade the way day traders do. And I know that there are successful day traders, folks who are making 30, 40, 50% a year, but they're the exception, not the rule. Most people lose an income by staying home to day trade, and they have to replace that. And without adequate capital and being very good at it, you can put yourself in a hole very quickly. The IRS has statistics that shows that most traders lose money. And by most, it's around 80% per year. So the argument has been made, well, that's just because they're declaring their losses those years. Well, if it's 80% year over year over year over year, that means 80% of the people are losing. So it doesn't matter that win from time to time. If you are losing over and over and over again, you might as well just be a gambler with a magical system that you're just going to keep tweaking and tipping waitresses to get that information you need to make your system work. The reality is that day trading, swing trading, any trading is difficult, and without basic technical indicators at your core, you're going to have a hard time. So even if you are a long-term investor, buying a company such as Exxon today in the 40s might not be a good idea, because the technicals of that company might tell you, maybe there's a problem with the fundamentals. Maybe I missed something in my fundamental analysis, and maybe the chart is telling me I should look again. And a lot of times that's what people don't understand about the charts and about technical indicators and quantitative analysis, is that really it is the aggregate of market wisdom, which is often distorted by fear and greed and emotional investing. But longer trends tend to be pointing to something. And if you can find a stock that's been turning over and starting to trend down for years, the odds of that trend breaking are very slim. Now, the shorter the trend, the less likely it is to be permanent. But the longer the trend, the more likely it is to be permanent, or at least longer term. And we're going to look at a couple of those things today. So the article that I put up on the technical trading basics, it's also on margin of safety investing. I'd like you to read it and really think it through. Because if we can come close on these pivots, we're going to make a lot of money. And then if we can ride these trends all the way back up towards the next pivot, we're going to make a lot of money in the middle too. So we can make money on the change in direction, and we can make money on the trend that it follows. So these signals are vitally important. If you are asking me, and people are still doing it, should I buy this now? Should I buy this now? I ask now, have you looked at the chart? Have you looked at relative strength index? Have you looked at money flow index? Have you looked at Chaikin money flow? Have you looked at MACD? And really those are the four that we're focusing on. And then I put in some exponential moving averages at the bottom of my charts to see if multiple moving averages over longer and longer time frames are changing. And are they all changing at the same time? If a 10-day average and a 20-day average and a 50-day average are all rolling over together, that's generally indicative of a pretty strong move. If the 10-day is moving one way, the 20-day is kind of stable, and the 50-day is going one direction or the other, you have to think logically, what do those things mean? Okay, the short term is down, but the long term is up. That means buy the dip. Okay, the short term is up, but the long term is down. That means sell the rip. Does that make sense to everybody? If the short term is going up, but it's within a long-term downtrend, that's an opportunity to sell. And if the long-term trend is up and there's a short-term trend down, that's an opportunity to buy. When we trade against the masses, we need to know ourselves. The first thing is that we're primarily position traders. Most of our money is intended to be held between 6 months and many years. We're not looking to trade most of our money most of the time. We're looking to hold most of our money in investments most of the time. It is rare that I go past 25% of my money in cash. And oftentimes when I'm 25% in cash, it's just because I'm selling cash secured puts to try to squeeze out 3 or 4 extra points on a position that I'm trying to get into. And maybe 25% of my money that's in cash is also allocated to swing trades. At the moment, I'm more along the lines of 50-50. About 50% of my money is position trades, and I think this is probably going to hold for me long term. For you, you can determine how you want to do it. Do I want 3/4 of my money to be long term and 1/4 that I'm going to trade a bit, or half and half? I've moved in the direction to half and half, particularly with certain types of accounts. People who want to sell options to generate income, probably 50-50. People who want to use trading to maximize returns, probably 50-50. People who want to adjust their asset allocation more often to account for changes in cycles, probably 50-50. But people who want to basically buy and hold a long-term low until it's 5, 6, 7 years later, it's a high, then maybe they don't trade much at all. And you just have to know for yourself, how do you want to play it? I had one guy call recently, and he's got a very substantial business. He makes something for Costco, and he asked me what I thought, and he was going to pay me for my advice. And he had about $3 or $4 million in pension type retirement accounts, so tax sheltered, and a couple $1,000,000 that were taxable. And the taxable account had a lot of embedded gains. So I told him, I said, look, some of these stocks are clearly overvalued. But it was Apple, it was Microsoft, it was companies like that. I said, if you wanted to trim those now, you'd want to take a look at your tax, your tax bracket, and see if you want to capture some of those gains now as the market is cresting again. And I said, other thing to consider is capital gains taxes are probably never going to be this low again. So this is probably a good year, especially since the market isn't recognizing a potential change in leadership yet and change in tax code to sell some of these holdings. But that's up to you, not a priority. Where I put the most of the priority was in his retirement plans, basically was S&P 500. And he had 4 different dividend ETFs that were all about the same with certain tweaks. And I said, why do you have 4 ETFs that do the same thing, right? And I said, with the S&P 500, maybe you want to reduce your exposure to a few sectors and increase your exposure to a few other sectors. And since it's a tax qualified plan and there's no taxes, why not move more in the direction of technology and things that are held by QQQ by upping your QQQ holdings, which you have a little bit of, but not much, and reducing your SPY holdings. And then if you want to add some sector or industry ETFs to overweight the smart everything world and the sustainable world and the work from home world that is emerging, do that. And you don't have to trade them very often, but it seems to me that right now is a good time to take a look at your asset allocation and think about how you want to be positioned for the next decade. Well, the fact that I had suggested that he should change anything really put him off because he thought he was doing everything right and that he was brilliant. So he ended up not hiring me. And I'll tell you, back in 2007, when I was buying dinners and, for people and telling them you should be selling houses, second houses, and real estate, they didn't want to hear it. And I had more clients fire me for wanting to get out of the economy, getting out of the stock market in 2007 and 8, than I had new ones hire me. And a bunch of those clients who fired me in 2007 and 8 came back in 2007, 2009, 2008, 2009, 2010, and wanted to rehire me. And I told them all no, except for one guy. So my point is, you need to define yourself and have a model portfolio, which we've talked about before, that is your strategic backbone. So if your strategic backbone is that you're usually half in position trades, which are long-term, and half in swing trades, which are, you have to manage more, that's fine. But know that's who you are. If you want to be 75-25, that's great. Do it that way. Now, for me, I just break it down into 4 quarters. That doesn't mean you could be 88% position trades or 82% position trades because you have some way in your head that makes sense. For me, I just break it into quarters. And it's fudgeable. Sometimes it's going to be 57%. Sometimes it's going to be 40%. But I want to gravitate towards about half of my money in position trades, about half of my money in swing trades, shorter term, under 6 months. I hope that makes sense. So here, even if you're a position trader, you're going to want to know roughly what kind of cycle you're playing out. So if we go to the S&P 500 and we pull out a monthly chart, right? Go back 20 years, we can see that if we had bought around here in 1999 and 2000, when everybody was super hyper about the stock market, we would have lost a bunch of money and not made it back for about 8 years. And at that point, we should have sold. Why? Because the market crashed. And then it was 4 years, 5 years almost, before it got back to even. So these giant market tops, where you get all these indicators, right, and overbought signals, relative strength index, super overbought in 1999, and then we had the crash. Super overbought in 2008, and we had a crash. 2018, and we had a bad year. Then it came back in 2019, and then it came back down. And this is a monthly chart, so it's not totally overbought yet, which means it could go higher right now. If we take a look at the weekly chart, which measures periods at every week, right? Weekly, monthly, daily, they all mean what they sound like, right? Just like Officer Wojciechowicz on Barney Miller. Spell it like it sounds. So when the stock market gets really overbought, right? Before the tech wreck, there was a good correction in there. Before the financial crisis, there were some corrections in here. From 2015 to 2016, we had the sideways market. 2018, we had 2 volatility events, pushed it down. 2020, we got extremely overbought again. Coronavirus crash, an incredibly fast shift in sentiment from overbought, dramatically overbought, to dramatically oversold quickly. And now a dramatic rebound. And now we're in the middle of the market. And you have to decide, which way is it going to go? Do I think it's going to break the one more level higher? Or do I think it's going to go turn back over? I think it's going to turn back over. I don't know exactly where it gets to first. So we take a look at these indicators and they'll help us. So the weekly charts are important. This is money flow index. This is essentially the volume weighted relative strength index. As you can see, money flow index is not as favorable as relative strength index. Relative strength index isn't guided by volume. So you don't know how strong the move is because it's not taking into account underlying volume. It's just the action of the day. And right now, it's holding up. It's got it right, right around 55. And we know the 70 is overbought. Every time it gets up here, there's usually a period at some point, right? Overbought doesn't last long. And then it turns over. Often it's event driven. Money flow index, if it's weaker than the relative strength index, if it's lower, that means that the volume doesn't support the price movements, which means that the market is usually going to turn over. Chaikin money flow, something else that I like. When it's negative, that means that more money is coming out of the market than going in. It is rare as in doesn't happen, the prices don't follow the Chaikin money flow. Now, when money flow is negative, often Chaikin money flow is negative, the stock market often becomes choppy. Doesn't always go down right away. Sometimes it just becomes choppy. So let's take a look at the last couple of months, right? Put it on a daily chart. That is not a big uptrend there, is it? Right? Had the rebound, but it's really been pretty choppy. Now, you'll notice something different about my charts. I happen to just have drawn the head and shoulders here. I'm not putting the extra lines in anymore. All these lines are Fibonacci levels, which are important to us. Green is the longest Fibonacci level that we're tracking. Blue is next. Those are retracement levels. And then the purple and the, whatever that is, a type of pink, are extension levels. And the pink is the oldest one we're tracking, and the purple is the newest one we're tracking. There will sometimes be a third set of Fibonacci levels in here, but I have found that 4 is usually enough, unless we're trying to pinpoint a specific area that the market is keen off of. Just so happens that the choppy period in 2015 and 16 coincided with the election at the end of 2016. So I believe that the stock market is keen off of the 2016 stock market levels. And that depending on how the election goes and how it looks like it's going to go soon, the market will react to that. I happen to think that in the very, very short term, a Trump victory that's still being postulated by many people is positive in the short term, and that a Trump loss is negative in the short term. But I think the picture is exactly flipped in talking with big investors and money managers on the other side. I think that in order to get an infrastructure bill and a Green New Deal type of thing going and create millions and millions of jobs quickly, in addition to a solution for coronavirus so that we can get our service industry up and running again, you're going to need a different type of leadership. So I don't think the tax cut, $1 trillion deficits in good times approach is going to work if you're not building anything. So what we need is a way to not go into uber debt, even more uber debt, right? We're already there. At least create cash flows so that we can build a lot of stuff again. And what do we know about supply chains? We know the supply chains are moving back to America, right? This is the reality of what's going on. My Macro Monday article, which will be out on Tuesday or Wednesday, one of the topics is that supply chains are disrupted and moving. And we have talked about that a number of times, going back a year or two, probably 2 years, that supply chains were going to move, not because of politics, but because of machine learning. So I'm uber bullish on a Biden presidency that brings in building projects, and from Green New Deal to water to roads to everything, to communications. And honestly, if Trump could get that done, I'd be cool about that too, right? Because really it's a matter of getting things done. So Mitch McConnell doesn't like those ideas, and he's blocked them all the way back to the Obama administration. So it probably takes a Biden presidency with a lot of Democratic senators to get that done. What is the flip side? Well, it just so happens that I've been sending messages to the Democrats. I know that some of them get read and some of them don't, or not getting taken seriously. But if you'll notice, President Biden's fundraiser they did yesterday, he said exactly the things that I've been saying to you for a year. That you don't raise income taxes, but you close loopholes, right? Closing loopholes is a winning argument. Raising income taxes is not. And that's what he talked about. So that he could do an infrastructure plan and something akin to a Green New Deal. Which doesn't mean print any more money than we've already printed. But it means that actually getting something for that money other than inflated asset prices and inflation that is embedded in the way we live, but not necessarily reflected in what the government shares in data. So if any of you have been buying meat lately, you know that the price of meat is darn near double if you want anything other than stuff that eats sand, right? If you want a good piece of beef or pork or chicken, you're not paying what you were paying a year ago. You're paying up 50% to double on everything. The only thing that there seems to be a bit of a glut of is some seafood, shrimp and lobster, because they're not being served in restaurants right now. So if you want to make some lobster tail this summer, I recommend that you hit the Costco or your local high-end grocery store and get what you need, because you can get lobster at a pretty good deal. So when we take a look at this chart, we want to know, is this head and shoulders going to play out? Or is this market going to break out to the recent high and go through it? Now, there's violating, this is just a visual. It's not anything technical. Certainly this could go here. If it goes above that level and then heads up to these highs, the head and shoulders could be invalidated. But really, this shoulder can get all the way up to the high as long as it doesn't go above it. So the market can go all the way up, say even here, right? As long as it doesn't set a new high, the head and shoulders is still in place. We know that head and shoulder patterns are very dangerous. And we've got one forming. Other analysts have talked about this. For another big correction not to be in play anymore, for a while anyway, right? Because there's always another one coming. This would have to break out to new highs. The market is trying to go higher right now. It's been trying all morning and it hasn't been able to pull it off. This is a 4-hour chart. And we can see relative strength index is fighting with itself. Money flow, still not very impressed, right? Just not impressed. The daily follows the 4-hour, the 4-hour follows the 1 hour. The 1 hour follows the half an hour, The half an hour follows the 5-minute chart, right? The shorter your time frame duration for wanting to make a trade, shorter the chart you'll use, and then compare it to the ones that are immediately longer. Chaikin money flow on the 4-hour, not impressed. How does it look on the daily? Not impressed. Weekly, not impressed. Chaikin money flow is screaming negative divergence, right? So when this indicator goes down, we know the price either becomes choppy or follows down. So far, we've been choppy. We would need to see significant money head into the markets for a real price breakout to the upside. We have not seen that yet. So this is important to watch. I also think the money flow index is important to watch. And this is the last month. Well, it's 30-minute chart. I don't want a 30-minute chart. I just want to look at more. There we go. Right? There isn't volume supporting the move in the price up, which means there's not money supporting the price up. This is just floating on hopium. This is standing on thin ice. We talked about this very early in the year because the charts look the same. And we got a big crash. And I'm telling you that that crash was coming anyway, probably about the same size. The difference is that with coronavirus, stock market crash could have gone all the way back to 12 to 1600, 1700 on the S&P 500, but it didn't because the Federal Reserve basically backstopped all the corporations that we're not letting you go bankrupt. At least with some corporations. A lot of the oil companies are already going bankrupt. Chesapeake Energy was the latest high-profile bankruptcy. I gave an interview last year, and I told you last year that Chesapeake was going bankrupt. And kids on the Seeking Alpha messages were telling me that was nuts. I'm like, look, I know people involved here. I make these calls. I talk to the investor relations people. I talk to analysts. Dallas Salazar has been saying that Chesapeake would go bankrupt for 2 years, maybe longer. He used to write at Seeking Alpha. He just started a hedge fund, which is something that I'm thinking about doing. I've been invited to do it. I'm not sure I want to live in Puerto Rico half the year. We'll see. But the reality is that this is never different. Ever, ever, ever. The most dangerous words in investing is it's different this time. Things do change, but sentimental, emotional investing is the same over and over and over again. Got a great uncle, worked in Vegas for 35 years, and his retirement job was his retirement gift was a seat on the Chicago Board of Option Exchange. And he traded the pits for a while, traded his own money, traded some other people's money, helped facilitate certain trades for people who wanted to move money back in the day. I've told that story before. We won't tell it here. He came into the office back when I was working with my uncle, 2002-ish. And there was a company called Priceline. And it was like $20 a share. He goes, hey, I'm going to buy $10,000 worth of Priceline. No, don't want to buy that. I heard two of the people in the office tell him, I'm going to buy it. sat him down. He knew to watch them make the trade. They made the trade. They bought $10,000 with the price line. You guys know what price line is now? Do you know what the price is? This used to be price line. He bought it for 20 bucks a share. Right? Priceline.com, man. Don't buy it. Don't buy it. Don't buy it. Is it going to stay in business? Yes. Okay. It's the only question you have to ask when there's a crash. Is it going to stay in business? When something is priced for going out of business, you only have to answer one question. Is it going to stay in business or not? If the answer is yeah, the trend is for technology to take over travel agencies, then yeah, this is a leader. So it got up on the hype, crashed, came in here and bought it in here. $10,000. About 20 bucks a share. I remember it was in the 20s. Now it's 1,500, right? Interestingly, in here, 2015-16, I told him to sell it. And he got like 1,200 bucks. So he missed a rally and a crash and probably another rally. But the dude's in his 80s. What does he care? Did all right. Hope I inherit some of that. So when we take a look at different stocks, we want to ask ourselves a question. What do we think the future is? Okay. Does this chart look at all like the price line chart? What does that look like? Okay. Symbol wrong? Yeah, I got the symbol wrong. There's actually a way for me to I don't know how to use this thing. The other system I use, you can just drag and drop, whatever. You can see what happened here. Just look at this area here. Look at that area there. Okay. Then let's go to SunPower. Does that not look similar? That's damn right. SunPower can be the next price line. So the question you have to ask when a stock is not priced well is why? And it's because there's rampant pessimism and boomer money that just doesn't want to get into solar. Because I remember solar from the 70s and 80s, and I'm never going to invest in solar because I lost money on it back then. Or I've been waiting 40 years for it. Well, God damn it, technology changes in 40 years. And the utilities and corporations are using solar. It is the fastest growing energy out there. About 11% of our energy and power, right, comes from alternative energy now. About 2/3 of the new alternative energy is solar. Growth rate is in the 20s. That means about every 4 years, capacity doubles. So we're going to go from 10-ish% alternative energy to 20% alternative energy by 2025. By 2030, we're probably going to be between 30 and 40% alternative energy. By 2040, we're going to be between 70 and 80% alternative energy, right? Because growth rate's slow. But we are moving to a world that is 70 to 80% alternative energy. This company has the backing of Total, which owns 3/4 of the company. Total's loaded, it's rich, it's the richest oil major out there. And they have been the fastest, absolute fastest in converting. Right? And there's people out there that think that the past is prologue. They ask questions about, well, isn't China being predatory? Have you not noticed that the world's stopping their China fixation? Have you not noticed that people are moving their supply chains out of China? If you don't own SunPower, I don't know why you're managing your own money. There, can I make that any stronger? Even if it's a small position, 1 or 2%, you need to own stocks with charts like this when you can answer a simple question. Is the big trend in their favor? And are they going to, and that's going to keep them in business. Are they going to stay in business, right? And ask why. Because the giant trend is in this direction. Who is that bad for? So I also hear, well, I'm never selling my Exxon because I made a lot of money in it in the 80s and 90s. Right? Buy and hold 2012 on Seeking Alpha says that shit to me all the time. He hasn't made dick on it in 20 years. He's down in the last 20 years. Because the price now is all the way back to the 2000 price. Do you know what the next price it's going to is? The 1990 price. That's the next price. Exxon's going under 20 and it's imminent. The price of oil is not going to go over $60 a barrel, even if there's a war. Because we've talked about this before, the oil glut is so big. So what these people ought to be thinking is, okay, what are the technicals telling me about Exxon? Well, here it was telling you thin ice. Now, maybe the ice cracked a little sooner than it otherwise would have because of coronavirus. The ice was going to crack. This stock was going to shit no matter what. And it's still going to go to shit. There is no rebound here. We're on a monthly chart. Who cares? A little bit of baby rebound. Take a look at Chaikin money flow. Underwater. This is actual money going into the stock. None. It hadn't been hardly any money for a long time. And that rally here right? Oh, Saudi Arabia is not going to hurt us. Oh, yeah, they are. Saudi Arabia is not going to hurt us. Oh, yeah, they are. Cars are moving in the direction of EVs and hybrids. They're mandated to have 44 miles to the gallon fleet by 2025, and that's the watered down version. Biden also said that he's going to roll that back. He's going to make it back to the standard it was before Trump, which was they'd have to be at 51 miles to the gallon or something by 2025. Every car company is telling you they're not going to build internal combustion engine cars. Sometime they're going to get rid of them in the second half of the 2020s. They'll have trucks, some bigger vehicles, but cars, passenger cars, SUVs, crossovers in particular, they're all, except for specialty vehicles, going to be hybrids and EVs. And now we're learning that the work from home economy is forever. Have you seen the news? There's a new swine flu. So by this winter, we could be dealing with coronavirus and another swine flu. We're not getting out of the house for a while. Neither is the economy. Neither is oil demand. And we're going to have to extend unemployment benefits and maybe even do a universal basic income temporarily. Something along those lines. So, Exxon. Switch it down to the daily chart. Tried to come back. Look what everything else has done. Right? Had this rally here. Not bad. What are the charts telling you now? Had its rally. Look at that. I want you to be able to see that. Relative strength index falling. Money flow falling. Money flow's at 40 now. Relative strength index about the same. So you've got these hangers on. These people are like, I'm gonna hold Exxon forever. Who's been buying Exxon? Nobody's been buying Exxon. You've just got people holding on to it because they're stubborn, because they can't read a chart, and they're unwilling to accept the oil is in its death knells. It's gonna be a long death. If you want to think of it in human years, right? We'll convert oil years like we convert dog years. In oil years, right? In human years, oil is about 80 years old. That's where you're at. Can oil live to be 100? Sure. Okay. So the oil age is 175 years old. So it's basically an oil year is a half a human year. Will we still be using oil in 40 years? Sure. But we'll be using a third or a quarter as much or less. So we ain't going to use it for transportation. And the ships, right? The ships are going to liquefy natural gas and natural gas and alternative energy too. Have you seen the new super freighters? They have solar on them. Now, they're not really powered by solar, not the engines anyway, but the other stuff is, onboard stuff is. So all the technical indicators, short-term, long-term, intermediate term, everything says that Exxon is going to crash. And it already started, I think. Got up to about 54 off of its $30 bottom on the idea that, hey, oil's going up in price. This coincided with oil going from 0 to 40. And oil has hit that first ceiling that I talked about of right around $40 a barrel because the glut is so big. Stock's coming down. And we've already seen Royal Dutch Shell cut their dividend. And I actually have a bookmark. Writing down $22 billion of assets for Shell. And there's all kind of, you want to just oil write-downs. Google it. You get 20 hits. Everybody's writing down assets. With Exxon, I've told you, their operations in South America are never, ever going to come to fruition. Off of Guyana and Suriname, they're not going to get half of what they say they're going to get. Because it's not going to be needed. Those leases are just going to expire worthless. Or Guyana is going to take them back. So this is a stock that I've been buying puts on this week. Yesterday, I actually bought a couple last week. I think that it's going under 40 imminently. And I think the next stop down is pretty low. It's in the 20s, upper 20s. And I think it'll hold in here for a little while. But ultimately, I think Exxon is going down to around 10 bucks a share, 9 bucks a share, 8 bucks a share. Again, they're not making money. Anybody who tells you they're making money doesn't understand what's going on. They're not making money at $40 a barrel. They have to shut down all of their high-cost projects to make money. But here's the problem. That's not enough money to pay their debts. So they've been selling assets. Nobody's bought in the last year. They have nothing of value that anybody wants to buy. You know, maybe for a song. There's no growth. And they took on debt to pay the dividend. What will the debt holders demand? Pretty easy question, right? The debt holders want to get paid. The dividend's going to have to be cut, and it's coming sooner than you think. I think it'll be this year. Could be the first quarter next year, but I think it's going to be this year. And I think that July is going to be the harbinger of the October profit period, earnings reports. I don't think the CEOs are ready to concede defeat to coronavirus just yet. But I think in October, it's going to be so bad by then that that'll be the kitchen sink quarter. So between now and October, I think we get a new low in the market. I think we break the lows. Because I don't think the government is going to, and the Fed is running out of bullets because they were only given so much money to buy bonds, right? For them to buy the bonds they bought required a change in law and an appropriation. They're not getting another appropriation. They're not before the election. So you're going to see a few more bankruptcies. Some of them will be big. And a lot of them will be in the oil sector. I should have said a few more bankruptcies. You're going to see a lot of bankruptcies. Another 10 or 20 in the oil sector by the end of the year. Exxon won't go out of business because they can split themselves up. But legitimately, Exxon, I mean, if they don't merge with Chevron or something, I mean, I could see Chevron down to $5 a share at some point in the next couple of years. This is an idea that I gave to the hedge funds 2 years ago. I sold this idea to the hedge funds in here. I only got $6,000 for the idea. How much do you think they made? I laid out why Exxon was going to collapse. I put bits and pieces on Chaikin Alpha. This is the next leg down. Bam. And it's going to happen soon. So I've been buying puts. And the mistake that people make when they buy their puts is they buy too far out. Why is that a mistake? Because you're paying for a ton of time value. Use these technical indicators to give you a heads up, right? This is a trend, right? We can tell that that was a spike. Now it's back to reality. It's just going to keep dunking down. So I bought August puts, $40 August puts for a couple bucks. I only need this to go to, like 34 and I triple my money. What if they cut the dividend sooner than I thought, right? But what I can probably do is I could take my profits in here, look for a bounce off of one of these levels, then buy new puts for a couple more months out. Because we know that these down moves usually move in 3 or 5 waves. 1, 2, 3, 4, 5, right? So I've talked about Elliott Waves. I don't think they're very precise. That's what we need these for. But Elliott Waves are accurate most of the time because these repeating patterns are repeating patterns because they repeat. Does it matter? Do we have to ask why? Who cares? Who cares why they repeat? They do. Because people are people and do the same silly things over and over again. So you could count wave counts in here and you would find Elliott waves in there. But they wouldn't really tell you exactly where things are going to turn. That's where Avi uses the Fibonacci stuff. This is what I'm using. I respect the Elliott waves are going to tell me some, give me some ideas. But I know that Chaikin money flow is going to really tell me, and money flow index is really going to tell me how strong these moves are and when they're going to happen. Again, why? Because money going into an asset pushes the price up, demand. Money not going into an asset, right? Money coming out of an asset, no demand. People selling. So very simple econ 101. If money's going out, price is going to follow down. Can hold up for a while, right? Just like a retailer who's getting beat by the store down the road. He can hang in there, but at some point, he's got to find his equilibrium price. The equilibrium price for Exxon is below 30. Yeah, it might be right here at 29, 28, but I think it's more down along the lines of 8, 10. So I think you can short this 2 or 3 times in the next year or so. At the very end of the day yesterday, at $19.99, I bought SDS. And if the market starts moving my way in the next few hours, I'm going to buy more. So I only took a 0.5% position. I want to see this hourly get oversold. I mean, we're really close. right? Money flow index is already there. So you're really close. If you want to day trade SDS, I think you can almost do it right now. 1 hour chart saying go for it. What's the 30-minute chart? There you go. Already starting to head back up. On the money flow index. That means the RSI will follow. There you go, bottomed out. 1 day ago it was up here. If you take a look, how's that for oscillation? Do you want something more consistent than that? It's almost a heartbeat. So I think you could buy SDS right now, like in the next hour, if you want to day trade it. If you don't want to day trade, then you need to look at SPI, decide if you want to buy the puts that I've been buying. So we go to the 30-minute chart. Look at that. 1 hour chart will generally follow. Yeah, so this is going to turn over. And the 4 hour chart will turn over. So it's about to head back down too. Where are we on the daily? Right, starting to head down. Not oversold yet, so it has more room to go. But this is in the middle of the market. So I actually like SDS more than buying puts right now, and holding SDS for a day or maybe two, but not much longer than that, right? Respect the heartbeat. 1, 2 days, right? You're not going to hold SDS more than a couple of days. You might buy it now and sell it at 259. My time is 259. The market gold is 359 on the East Coast, right? Tell me that you see a lot of things more regular than that. So if you want to trade SDS, I don't use the triple leveraged just because they actually mathematically don't help you any more than the double. If you take a look at them, they're almost identical. And the triple will blow you up if you get it wrong. This will blow you up slower. Yeah, it might only make you deaf. I don't know, man. I think that's pretty clear, right? Could it be more in front of you? Right? I just looked and saw a question, how long might I hold SDS? From hours to a couple of days. The only way I would hold SDS longer than a day or two is if we just suddenly, for a big event reason, went back into 2 weeks of crash mode, right? So like back here in March, even in March, you could have traded it. You probably would have gotten your days just about right. So there's no exception. Don't ever ask me again. I'll just have to keep saying it for the new people. All leveraged or inverse ETFs are based on futures, which means by design, they reset every day, which means they are day trading vehicles. They are never, nor are they even, they're never ever supposed to be held long term. That is not what they're designed for. They are not built to be held. They are built to be traded. So trade them. But I think you buy SDS right now, you get it for just a little cheaper than I did. I bought it right about here yesterday at the market close right there, I think. Right. Like I literally bought it at 259 and like 60 seconds yesterday. I bought it 40 seconds. I bought it 20 seconds before the close yesterday. I got it at $19.99. So, any questions about SDS? And then we're going to call it a day. Nope. All right. There you go. There's your short ideas. I think you can day trade SDS. I think you should build a put position in Exxon because for whatever reason, there's enough stubbornness that you can get the puts cheap. And where do you get out? Dude. Where do you get out? When the chart says what? When it gets up here. You can let it go overbought if you want. You see, it never stops much before the middle. You for sure can ride it to here. If you want to sell part of your position, remember, scale in, scale out, sell some in here. Now you're free rolling. If it gets up here, then sell the rest. You know, when it gets to here, you're playing with house money, right? Take your money off the table and let the rest of it ride. Now, I will say, if there's an event, it's wrong to take any money off the table. And we know that, so did you know that 40% of the people in the country are now living somewhere where the reopening was reversed? So half the country is now under a reversal of the reopening orders. They're pulling them back. That seems pretty event to me. Wisconsin was going to go towards 50% capacity in restaurants July 1st, tomorrow. That has not been finalized, and it's June 30th. I've been saying it for 2 months. The phase 1 reopening is going to be with us until next year. You are not going to see more reopening than we have until about this time next year. Just not going to happen. One stock that, if it comes back to us, and some of us bought this last year for other reasons. I want to see the weekly chart. If I were going to buy a stock, I'd be looking at Merck. Merck has something with coronavirus that I think is getting overlooked. They made an investment in a Miami company that had bought the rights to something like a couple weeks before Merck approached a university about something. And it's a pill that would aid in treatment of coronavirus. It's not a prevention. It's, if you get it, you take these pills for 5 days, and it basically causes a mutation in the coronavirus. The problem is that if you take something like that long term, it can actually give you cancer. So they have to do carcinogenic tests on it to see if they can give it to you for this thing without causing a new bad thing, right? So we'll see if it gets to market. My guess is that Merck's technology can change this pill's dynamics in a way that prevents other mutations. And this is something that they were going to use for SARS and MERS. So if I'm going to buy, if I want a company, I'm probably buying Merck down around the 200-day moving average, 72-ish. I think you sell puts on it if you want to. But, you know, they pay a pretty good dividend too. So last year, I said Merck is my favorite pharma. You know, look at this good basing pattern, and it broke out. I think you can buy the corrections on Merck. I don't like Pfizer because I don't think the RNA things are going to work. I don't like Moderna. I think Moderna you can short the shit out of. Right? That doesn't look like a market. You think it's going to jump further up? Is that what you're hoping for? Another zoom to the moon? Ain't going to happen. First of all, RNAs are going to fail. More likely than not, they're going to fail. Boom, 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 boom. Then it goes all the way back down into the 30s or 20s. So I don't know if their puts are cheap. If their puts are cheap, I would be buying the puts probably to September because they won't have a lot of news before then. And then Trump's going to lie about how good it is in October, so it'll pop back up. And then you can buy more puts. That's how I think about it. Hype, deflation, hype, crash. Right? Yeah, well, that's what I was just talking about. The Merck oral antiviral is what I was just, I was just talking about that. Exactly. They're working with Ridgeback. Exactly. I think that's what I just said. The article's in the Financial Times right now. So here, right here. This is the one. I'm telling you, Financial Times has the best coverage of companies. Bloomberg has the best coverage of the economy and markets. The Wall Street Journal, you know, they're second best at all that stuff. So I get all three of them. But yeah, this is, you know, you can't buy Ridgeback. They're privately owned. But you can buy Merck. And I'll tell you what, if this works, and we don't know that it will, but Merck is a company that you'd buy anyway, right? So this is one of those things you say, I like Merck anyway, pays me a dividend, right? They got all the other pills. So I think if you want to buy, just if you're a dividend investor and you just want something slow and steady that might have some pop to it, Merck, right? That's how you win. You don't just buy the dividend. Buy the potential growth underlying the dividend, right? The dividend is just what you get for waiting for the growth. Don't ever accept a dividend for the sake of the dividend. The dividend is a placeholder for good things that could happen down the road. Exxon, the dividend's going away. But really, whoops, you tell me, chart machine, help me. What good has that dividend done in the last 20 years? The stock price is round tripped. Where it was around the start of the century is where it is now. So where it ended in the 90s is where it is now. It's going back to the 80s, baby. You're going to get a 1980s price on ExxonMobil. This is all perpetuated by wars and government policy. And now, no more wars. And it wouldn't matter anyway because the gut's so big and and technology is changing it. We're not going to need oil so much, or even natural gas. So, all right, have a great day. I'm helping my daughter move into her new salon in 3 hours, and I'm pretty excited about it. I think my daughter is going to be added to my retirement plan. I'll have to check to see if I can make her tax qualified. How much money she can give me when I'm old. All right. Everybody have a good rest of the day. And I think I gave you some pretty good ideas. I hope you use them. I'm going to put this up on the internet, but not until after the market. So people who want these trades need to watch this show live.